It's tough to exaggerate the importance of CMHC in Canada's housing finance market. You dominate the insurance segment, you dominate securitization, you're the administrator of the legal covered bond market, and you have a major role in social housing as well. And we're going to get to all these questions in the next 20 minutes. But you have news this morning. You're releasing your stress testing results for 2018. Right. Can you give us a rundown of the numbers?
Okay, so I won't get into all the numbers, but I'll give you a little bit of history on our stress testing program. We started releasing our results about, I guess about 3 years ago. This is the 4th year of publicly releasing the results. And if you work for a financial institutions, you're probably familiar with the own stress testing that happens in your firm. And at CMHC, we decided that given our status as a financial institution and given the size of our balance sheet, that it was prudent from a risk management perspective to conduct stress testing activities in the same way that any financial institution would. I know in Canada, and this may be a little bit not consistent with what happens in the US, our large banks do not release the internal stress testing results, but CMHC, because we are ultimately backed by Canadian taxpayers, we thought that for the sake of transparency, it's really a good idea to show publicly the impact of very severe economic events on our balance sheet. So this is the 4th year we're releasing our results. And it is a little bit of a good news story in that I think stress testing in some ways is a bit of an active imagination. You're trying to think of scenarios which are pretty severe and probably not very likely to happen, but possible. And under all the various scenarios, we find that we have sufficient levels of capital to withstand the shock. So I think this gives a sense of comfort to Canadian taxpayers and to the market at large that we're managing our risks appropriately and that we're appropriately capitalized.
But you've started delivering a regular dividend now to the government. How is that impacting your capital adequacy?
Yeah, so stress testing and capital adequacy assessment is very intricately aligned. So before we make decisions about how much dividend that we repatriate to the Canadian government, we run the stress testing scenarios, we pick capital targets, and we determine the amount of dividend accordingly. And as you know, determining the dividend is a dynamic process. So as we go through each quarter, we look at our assumptions and and make decisions accordingly.
I actually have seen the numbers. There's one scenario, financial stress scenario.
Yeah.
Where your minimum capital test ratio falls below 100%.
That's correct, yes.
Is that something to be worried about? That's a situation where you actually won't be able to provide funding to the industry, right?
Well, yes, and according to what happens, we're not regulated by OSFI, but we're supervised by OSFI like any other insurance company. And when your capital goes below 100%, that's at the point at which OSFI starts to take regulatory action. So it's a very important sort of line in the sand for us. The important thing to remember when you're looking at that particular scenario where our ratios go below 100%, it assumes that we take no management action. So which means that we continue to pay dividends that we promised to the government in our corporate plan. So it's actually quite an extreme scenario because in reality, if we were actually going through a scenario like that, we would actually make changes to our dividend payments to make sure that we remain adequately capitalized. But we felt just for the sake of prudence that we took sort of the extreme case to show the impact of the actual financial impact on our balance sheet.
So in a severe downturn, CMHC is confident it can continue funding the industry?
Absolutely, yes.
Yeah. We've heard a lot of scare stories around Canada's housing market, particularly in New York. People are always looking at the Toronto and Vancouver housing markets. People have been predicting the collapse now for 7, 8 years. It hasn't happened. There's there are lots of confusion maybe around what may be happening in the market there. Can you provide some thoughts or share some thoughts on what exactly is going on in the Toronto and Vancouver housing markets?
Yeah, so I encourage people to check out CMHC's website because we do every quarter we release information about our latest assessment of the various housing markets across Canada. Because as everyone knows, there's not one housing market in Canada. There's a conglomeration of regional markets, and you are right. There is always concern about the Vancouver and Toronto market. And our assessment there is that the price escalation has moderated thanks to actions taken by the federal government, but also actions taken by the provincial and municipal governments in those areas. So we are less concerned than we were, but our analysis is that the price escalation is really caused by lack of supply. So, and especially in Vancouver, the supply response is very weak. And one of the things that we're focused on at CMHC is housing affordability. And we feel that there is a need for alternative forms of housing in those areas, in particular, more dense housing, more purpose-built rental. And we feel that there needs to be a concerted effort by all levels of government and the private sector to try to meet those supply needs. And we feel that in order to really to moderate prices in the long term, that has to be a supply response. And we have to also remember that the problems that Vancouver and Toronto are having are global problems. It's the issue that we have in all international cities around the world. So we have to learn from each other in terms of how to really tackle the affordability problem, because as a government entity, we're actually very concerned about the lack of affordability housing causing other social ills. And I think, I don't know if you've heard about our national housing strategy, but the government, the federal government of Canada is investing $10 billion Canadian in housing over the next 10 years to really encourage more affordable housing types and to really help Canadians who are in housing need. And we feel that that's one step towards resolving the affordability problem. But as you know, you need many more players at the table playing in that space.
So the implication is that you're not worried about the demand side then, if you think it's supply side problem.
Yes, yeah. Of course, it's never black or white, one or the other, but I think our view is that we need to focus on the supply. And when you look at since the it's hard to believe, but the financial crisis was 10 years ago. There's been a series of deliberate government actions to de-risk the mortgage market. And when you actually look at CMHC's book, it's much the risk levels are much lower. The quality of our book is much better than it was 10 years ago. And so I think CMB investors can take some comfort from that. But we've taken the government direction to de-risk our balance sheet very seriously, and we've done that in a very gradual, responsible way.
Now, you are CMHC's first chief commercial officer. So the organization brought together its insurance group with its securitization group, mm-hmm. and created your role. Why did you do that? Why did Evan Stell do that?
Okay, it's not a very exciting reason, actually. It's I would say efficiency is probably the most the primary reason, and also another reason is client service. So. At CMHC, we sort of divide up our world into two segments. One is the commercial business, basically securitization business, and the mortgage insurance business that actually earns revenues for the Canadian government. And then we have sort of an appropriations-based business, which is basically the social housing and policy groups that operate without profit. And in the past, there was a thought that you needed to keep the securitization business very separate from the mortgage insurance business for competitive reasons. The securitization business is basically a government monopoly, and in the mortgage insurance business, we have competition with private sector players. So the thought was by separating it, you made sure that you weren't using your government monopoly to drive business to the mortgage insurance business. But and of course, that's still a very serious consideration, and we have governance practices to make sure that doesn't happen, but we felt that you didn't actually need to keep the two organizations separate, that there was efficiencies in combining them, and that we could actually serve our clients better. Because if you work at a Canadian bank, you don't think about CMHC in terms of these segmented views. You want one person that you can contact in resolving questions or issues that you may have, and I'm that one person.
All right. Okay, let's talk a little bit about your guarantee programs. Can you give us a quick update on the state of public securitization in Canada?
Public securitization. So if you look at mortgages in Canada, I think it's I don't know what the exact latest number, but I think it's about $1.5 $1.5 trillion of mortgages outstanding. Through our CMHC programs, the CMB and NHA MBS, we fund about a third of that. So that's in the insured space. And then, as you mentioned earlier, that we're the administrators of the covered bond legal framework, and covered bond provides another, like say, 10% of the funding, and the rest of the funding is just private sector sources of funding.
CMB issuance has been around $40 billion now for a few years. Is that what's
No change. We plan to. That's our plan for this year, and I think we're pretty well on track to meeting those targets. So we don't see any changes there.
Have you seen any interesting trends in that market? Any changes in investor profile? What's pricing looking like?
Nothing. No significant changes. I think the one thing that. If you can call it industry trend, we have had greater inquiries from our lenders and issuers about possible government involvement and other sources of private sector funding. So as you know, like the insured mortgage space is shrinking over time, and that's sort of basically the product that eventually gets funneled through our securitization program. So as the insured market shrinks, you need to have an alternative funding sources. So we have had questions about right now the covered bond program is very dominated by the large Canadian banks. So there are banks on sort of the next tier in terms of asset size who are interested in joining sort of the covered bond government bond framework, but it's very difficult to make the economics work because of some of the costs of entry are quite high. So we've been thinking about how to really make that work. In addition, there has been questions about sort of starting up the RMBS market in Canada as well, and I'm always open to discussions with people who are actually in the industry, because we really need some ideas about like if we want non-government guaranteed funding, alternative funding sources, what role can government play in basically getting that market started? And we're always very open to getting feedback and new ideas from the industry. So I welcome people to bring their ideas forward.
Do you have any theories? Because I mean, we've been hearing for a while that you want more or maybe less of a role from CMHC in securitization, but the numbers suggest that private securitization and even the covered bond market is kind of flat. Mm-hmm. It really hasn't been kind of stepping up. Is any thoughts on what those steps that the government can do to promote the market could be?
And so on the covered bond side, one thing that really restricts the sort of the second tier of issuers from participating in the covered bond space is the 4% asset cap imposed by OSFI. And I know OSFI is looking at that, because I know in other institutions the covered bond limit is more institution specific. So I think changes in that area, or some sort of willingness by OSFI to reconsider that, would bring more players to the forefront. So that's one idea.
Do you think a rising rate environment is impacting in any way that market?
I think so. I mean, it's still early days for the rising rate environment. So I think as time passes, I think there'll be greater pressures. And I think one of the things that we are focused in the securitization area is really exploring these alternative funding sources. I think in the past we've focused more on keeping the existing programs working, and there has been a lot of product innovation in the space for quite some time. So we are hoping to shift gears a little bit and play a little bit more active role in thinking through some of these ideas.
Just quickly at some regulatory issues, have you seen an impact, or what impact have you seen from the B20 regulations?
B20, so it's, I think I say this every time someone asks, so it's still, as you know, it took effect in January 2018, so we're about halfway through. And on the mortgage insurance side, there's been about a 10% reduction in our volumes, and I think that's sort of seems to be the common view across the market. So I think the impact has been moderate and in line with expectations. But it is still early days. I think our view is that it's going to take the rest of the year just to see what the true impact is. We see there has been a reduction in the really highly leveraged mortgage borrowers, and I think that was part of the intended impact in terms of taking out some of that vulnerability from our housing market.
Are you worried that the risk is shifting towards non-federally regulated sector?
There is a concern about that for sure, and my colleagues at the Department of Finance are very vigilant in monitoring that. Again, it's too early to say. I would say that segment of the market is still quite small, so it's not. I don't think it's a source of concern, but it's something that the government is definitely looking at very carefully.
Any implications for CMHC there in any way?
One of the things, no implications for CMHC, but in order to, as a good risk management practice on the securitization programs, we've started requiring all issuers who participate in the securitization programs to provide information to us on a continuous basis about their entire mortgage portfolio. In the past, we just asked for data about the insured mortgages, but we felt that because through the securitization programs we're exposed to the risk of the entire institution. We felt we needed to have a better sense of all the issuers' mortgage lending activities. So we're in the process of implementing this new data request, and we're going to be analyzing this very rich source of data on a continuous basis to ensure that we're managing the securitization programs in a responsible way.
I want to talk about the rental market. I know this is becoming a focus for CMHC in the multi-unit market. Yep. Can you tell us what CMHC is doing on that side of the market?
Sure. I think I could talk for hours about this. But anyway, so sort of an exciting development happened this year. Like in the past, the transactional homeowner business dominated CMHC's commercial business. So this year, for the first time, we're actually insuring more units of multi-unit than transactional homeowner. And that's because we insure multi-unit residential buildings, and we've actually made some policy changes to encourage developers who are able to not only build multi-unit residential, but to create buildings where there are more affordable units available for Canadians. And some of these policy changes have really spiked the demand for the product, and we're very proud that we've been able to participate more in this, because there is a lack of purpose-built multi-residential building all across Canada, and we feel that's contributing partly to the house price escalation. So to the extent that government can play some role in incenting building of this alternative housing stock, we're very happy to play a role.
And this is part of the Canadian, the Liberal government's housing strategy plan, right?
There is an element that's part of that.
Sorry, it's the National Housing Strategy.
Yeah, that's right. Yeah, in the commercial space, when you look at the housing continuum, we're much more we're linked to the multi-unit residential buildings that are much more close to market. But as you go down the housing spectrum in terms of more the social housing area, there's other programs and funds that the government has provided to encourage development in that area as well.
Now we're running out of time, so maybe last question. Your CEO, Evan Sidal, has talked about CMHC in the years following the financial crisis being in a strategic drift, growth for growth's sake, and a return to basics and that sort of thing. I mean, we see obviously your securitization is kind of not going anywhere really. It's kind of steady as she goes. You're focusing now on the social housing side, and you seem to be very keen in participating in the housing strategy. What role will CMHC play in Canada's housing finance market in 5 years from now? What will CMHC look like in 5 years from now?
So I think CMHC has is a very dynamic organization, and it has changed a lot over time. As you know, when it was set up after World War II, it was basically set up to house veterans coming back from war. So from the war, right? So you can see like there's been a change in its mandate across time as the needs of society and government change. So I think that's just part of CMHC. Our view is that CMHC should be engaged in activities that the private sector cannot engage in, where it makes sense for the government to play a role. And you can call it strategic drift, or there's other ways to describe it. But I think during the financial crisis, CMHC played a very special role was very active, and I think our market share in the mortgage insurance business was close to 90%, and our balance sheet grew very rapidly because of some of the extraordinary actions that we were taking to ensure that Canada did not suffer the adverse impacts of the financial crisis, and we were very successful in that. And when you look at the 10 years that's passed since then, we've basically been right-sizing ourselves. It's not appropriate for CMHC to play such a dominant role in the market. So we're quite happy with where we are now. And I think the focus now is shifting towards housing affordability, because that's an area where we think that the government has a special role to play. That doesn't mean we're going to abandon our mortgage insurance business or securitization business. It's just a shift in emphasis. And I hope that in 5 years' time, we've made a significant contribution to addressing the housing affordability dilemma, and that's played a very positive role in ensuring that Canada remains an inclusive, equitable place to live, and that this will promote further economic growth and well-being for all Canadians. So that would be what's 5 years is a short time. I don't know if we can achieve all that in that time, but that's our goal.
Thank you, Romy.
Yeah, thank you so much.